Hey everyone, welcome to another video by Optionables. My name is Saket and today in this video we are going to discuss about trading in different VIX environment. So if you recall, certain months back, 2 or 3 months back, VIX was trading close to around 18 to 20 levels. But right now VIX is somewhere around 13. So that means there was a massive drop in VIX, and not just the VIX but also in the option premiums. So if you recall, when VIX was around 20 and the ATM short straddle for Bank Nifty on a Friday was pricing in close to around 800 to 850 points. But today when VIX is around 13, the same Bank Nifty ATM short straddle on a Friday morning is pricing in just around 500 to 550 points. So there is a huge drop in option premiums, almost around 300 points drop. Because of this drop in VIX, November month would have been fantastic for option sellers. Why? Because they would have two factors playing in their favor. One is the theta and one is the vega. So as the volatility is falling, the option prices will also end up crashing because of the low VIX. So this transition phase is a fantastic phase for option sellers when we actually fall from a higher VIX environment to lower VIX environment. But what is the problem that option sellers are facing today? The main issue is they are not getting the same premiums what they used to get before. So before, as we discussed, we used to get almost around 800 to 850 points on a Friday morning, but right now we are only getting 500 points. And once we are used to trading with huge premiums, right now we feel the premiums are not enough to go and end up selling. So many people find it hard or are facing difficulty in selling options in such a low VIX environment. So I am going to discuss various factors and everything will be backed by data. We are going to go through the historical data, do a thorough analysis of the market conditions under different VIX environment, and we are going to draw a conclusion. So that's the reason I request you to watch it till the end. I am going to show you under which VIX environment it is more beneficial for the option seller. I am going to also discuss different perspectives. One regarding the system trade perspective, discretionary trade perspective, and I am also going to discuss regarding the intraday and positional trade perspective. So now we will be quickly moving on to the screen recording, before which I would request you to watch the video till the end. Why? Because while we do the analysis of market data under different VIX environment, we are also going to discuss about the mindset or our psychology during different VIX environment and how it is going to affect us. That's the reason I would urge you to watch the video till the end. And meanwhile, if you are liking the content on this channel, do not forget to hit the like button, share this video and subscribe to Optionables. Thank you so much for joining. Hey everyone, welcome to the video. In this video, we are going to do a thorough analysis of market behavior under different VIX conditions. So we are also going to see how it is going to affect the discretionary trade and how it is also going to affect our system trades. Whether high VIX is better for discretionary trades or low VIX is better. And also when we come to system trade, what is more preferred. As you can see, here I have opened an Excel sheet where I have Nifty weekly as well as daily data from 1st January 2017. So you can see as I scroll down, from January 1st, 2017, this is the weekly data of Nifty. In here, we have the daily data of Nifty, again from 1st January 2017. As you can see here, we have already done some prior analysis. So you can see the VIX column, the high and low of the day column, open to close of the day, and also the gap. And similarly, we have for the weekly analysis as well. So you can see this data looks pretty clumsy if I just show you in the tabular format. So the better way to represent this data is by a chart. So when we chart out this entire data, we will be getting a much better idea, or it would be more easier to understand visually. So that is exactly what we have done here. So first I'm going to show you the summary in the table format, and later I'm going to show you in the chart format. So what exactly have we done in this analysis? So first we filtered out all the days which has VIX under 14. So if the VIX during that day was under 14, we have filtered out and we have compared it with the previous day. So what is the average gap up or a gap down? So we got to know that if VIX is under 14, we can expect a gap of 0.2% on an average. So here I am using the absolute term. So what exactly do I mean by that? That means if you see an average of 0.24%, do not assume that it is going to be positive 0.24%. So we are using the absolute number here. That means it can either be positive 0.24% or it can be a negative 0.24%. So this is on the days when VIX is under 14. So this is the expected gap up or a gap down when VIX is under 14. So similarly, when VIX is between 14 to 20, right? The daily gap up or gap down expected is around 0.4% on the absolute terms. So what do I mean on the absolute terms? It can either be positive 0.4% or it can be negative 0.4%. And this is the average gap up or gap down. And similarly, if VIX is greater than 20, right? So then the average gap up or gap down which is expected is going to be closer to 0.75%. And this is the exact reason why we are going to get higher premiums when VIX is more. So more the VIX, higher the premiums is what we are going to receive. So you can also see that the average gap up or gap down is much bigger when the VIX is higher compared to VIX is lower, right? So how much is the difference? Almost around 3 times. So when VIX is under 14, the expected gap up or gap down is under 0.25%, whereas when VIX is greater than 20, it is 0.75%, which is 3 times. And this is the exact reason why we get higher premiums for carrying the position overnight also. So now we are also going to see the open and close difference. So average difference between the open of the day and close of the day. Again, here you see the days when VIX is lesser than 14, the average difference between open to close is around 0.4%. So that means usually you can expect from the open on an average of 0.4% difference between the close. So again, here we are using the absolute terms. It can either be positive 0.4% or negative 0.4%. Similarly, when we come to the days when VIX is between 14 and 20, so you can see the difference between open and close is almost 0.56% on an average. And similarly, if VIX is greater than 20, the difference between high and close is close to 1%. And finally, when we come to the last aspect, that is difference between the day high and day low. So how much is going to be the difference between day high, day low? You can see days when VIX is under 14, the difference between high and low on an average is expected to be 0.78%. So we have collected almost around 5 years data, almost around 6 years, not even 5 years. So almost close to 6 years of data. And based on that, whenever VIX is under 14, the difference between high and low of the day is almost around 0.78%. So when VIX is between 14 to 20, it is going to be around 1%. And when VIX is greater than 20, the difference between high and low is almost around 1.78%. Again, this clearly shows why when VIX is higher, we are going to get more premium. Quite clearly because the volatility in the market is going to be very high. So here we can see it is almost 2 times higher, 2.5 times higher. Here again we can see it's close to around 2.5 times higher, and here you can see it's almost around 3 times higher. So no wonder you're always going to get higher premium when the VIX is going to be more. So does that mean trading with high VIX is much easier than trading with low VIX? The answer to this is no. So now when we actually look at this chart graphically, right? So you can see the blue bar here is representation of days when VIX was under 14. And the orange bar is representation of the days when VIX was between 14 to 20. And the gray bar is representation of the days when VIX was greater than 20. And we can see right over here. So when we come to gap analysis, so the gap up or gap down analysis, so this is the expected gap up or gap down when VIX is under 14, and this is the expected gap up or gap down when VIX is greater than 20. So you can again see the difference between open and close, right? So when VIX is under 14, 0.4% is the expected difference between open and close, and almost around 0.8% when VIX is greater than 20. And the difference between high and low, again, we can quite clearly see here. When VIX is under 14, we can expect difference between high and low close to around 0.8%. And when VIX is over 20, the difference usually goes up to 1.7 to 1.8%. And similarly, let's do a quick analysis for weekly data as well. So let's quickly come here and take a look at the weekly data. So you can see here, when VIX is under 14, week open to week close generally is in the range of 1.03%. That means opening of the week till closing of the week, the average is 1.03%. And when VIX is under 14, the difference between Nifty high and Nifty low. So here, obviously, we are talking about Nifty data only. So the average difference between Nifty high and Nifty low in a week is 2.04%. So how much is 2.04%? It is going to be somewhere close to around 360 points. Beyond this, the chart becomes pretty much self-explanatory. So when VIX is between 14 to 20, the difference between open to close for Nifty on an average basis is going to be 1.48, and when it is greater than 20, it is going to be 2.48. So you can see the expected move in the market when VIX is lesser than 14 is close to around 1%, whereas when VIX is greater than 20, it is 2.48%. So the average expected move itself is close to around 2.5 times higher when VIX is greater than 20. The average difference between Nifty week high and week low is around 2.04%, and when VIX is greater than 20, it is around 4.63%. And again here you can see the range is almost close to 2 times higher, 2.2 times higher. We can again see the graphical representation. So the weekly open close difference when VIX is under 14 is around 1%, but when VIX is over 20 is around 2.5%. And similarly, when you come to weekly high and low, so when VIX is under 14, it's around 2%. When VIX is above 20, it is around 4.6%. So this will give us a better idea because we are visualizing the entire data. So this chart right over here is almost summarizing you a data worth of 1400 days just in 9 bars. So now we are going to discuss when exactly it becomes easier to trade discretionary trades and system trades. So here we spoke about two discretionary and system trades. So when VIX is high, is discretionary easy? Or when VIX is low, discretionary is easy. Similarly, we are also going to do a small analysis for system trade also. So I think with this particular thing, it should be clear that whenever VIX is high, obviously the premium is going to be higher because market volatility is expected to be very high. But when VIX is low, obviously the premiums what we get is going to be very low because we don't expect huge volatility in the market. So it is the simple reason why when VIX is more, we get more premiums. When VIX is less, we get lesser premiums. So right over here, I have opened the Nifty 30-minute chart on TradingView. Let's end up marking the support and resistance for Nifty. Just by looking at this chart, we can end up marking a support around 18,450 and a resistance around 18,900. So for now, let's keep this to be our support and resistance. I'm going to tell you why exactly it becomes slightly easier to trade when the VIX is actually low. When the VIX is under 14, we can expect a move of close to around 1.03%. So this is from opening of the week to closing of the week. Similarly, when the VIX is greater than 20, the expected move is around 2.48%. So I'm going to show you how exactly this is going to make a difference. So before coming to open and close, let's quickly look at the high and low. So this is around 2% and this is going to be around 4.63%. So we are first going to come and look at this 2%. That means the expected high or low is going to be around 18,500 to 18,860. So this is going to be covering close to around 2%, right? So this is going to be the expected range or expected difference between high and low when VIX is trading under 14. And you can see this is well within the support or resistance that we have marked. Why is it so important? This is important because if it is well within the support or resistance what we have marked, then there are higher chances that we won't even end up adjusting the trade at all. So now I'm going to show you what would be the case if VIX was actually above 20. So if VIX was above 20, the expected range is close to around 4.5%. And 4.5% is actually quite huge. It is close to around 840 points. That means the difference between high and low can be anywhere like 19,000 to 18,200, which is going to come over here. So this is going to be the expected difference in the high and low when the VIX is trading above 20. So now you can clearly see why there is going to be a difference when you actually trade with low VIX. Even though you are getting lower premium, there are very less chances you actually end up adjusting because the market is well within the range of your support and resistance, which means you wouldn't even adjust your trade. But when it comes to VIX greater than 20, you see the range is huge. So the range is close to around 837 points. So this is the expected difference between high and low. That means very likely if the market comes down, let's say it comes towards 18,200, you adjust here, the market is going to come back and end somewhere over here. Or let's say market goes to 19,000 and you adjust somewhere around 19,000 and the market again comes back and ends somewhere in the range, right? So because of this, the amount of adjustments what we end up doing will generally be very high when the VIX is high because the markets will be very volatile. Even though the premiums are going to be priced right. So when the VIX is high, definitely you are going to get higher premiums. But the issue here remains to be that if the market is actually going to 18,200, psychologically you won't be in a place to hold the position. So very likely you are going to exit your position and the market is going to bounce back. But when we come to the days when VIX is under 14, so the range or the expected range between high and low is very small. So if the market goes all the way over here, takes a support, bounces back and comes to the center, market goes all the way here, faces resistance and comes down. So in this case, even though let's say the market ends up at the same place, so let's assume they are ending at the same place, very likely you wouldn't do any adjustment when the volatility is low. And you will definitely end up doing an adjustment when the volatility is high. So that's the reason your profitability without even you realizing will increase in the lower VIX environment. Even though the premiums are lower, that is absolutely fine because the amount of adjustments what you end up doing is going to be fairly very low. Why? Because the market is not going to move quite a lot. Just to give you a brief idea why this happens. So when you're trading and let's say the market actually ends up moving 300, 400 points, psychologically, you would be having a big M2M loss. So let's say today we get to see a rally of close to around 200, 250 points. So we are going to have a big M2M loss. And most likely, let's say it has actually broken our support right over here. So if the support is broken, most likely we will end up adjusting. But when the VIX is over 20, generally the range itself is going to be very wide between high and low. So let's say we end up adjusting here, then the market can go down for one more day and then end up bouncing back up. So this is very likely to happen because one, immediately as the market starts to move, there is going to be imbalance in premium and it is not possible if you're sitting in front of the screen to watch this imbalance and not adjust your trade. What we discussed now for positional trade also holds good for intraday trading. So here the amount of adjustments what we are going to make is going to stay very low because the range of the market itself is going to be low. So now if we have to summarize the entire thing, it is very simple. One, if the VIX is low, the volatility is going to be low. If the volatility is low, the range is going to remain very small. If the range is small, the amount of adjustments what we are going to do is going to come down drastically. And if the adjustments or the amount of adjustments what we do comes down, most likely that we are going to remain more profitable than the days when we actually end up adjusting. So even though the premiums what we are going to get is going to come down, the overall profitability is going to slightly go up because we are going to end up adjusting lesser and the market is going to stay in a very small range. So one thing I would want to clarify here is when you actually, let's say if there's a switch called psychology, when you can switch it on and switch it off, let's say you had nothing called as an emotion or you had nothing called as psychology, right? In that particular aspect, the premiums would be pricing in the volatility the right way. And it would make no difference if VIX is trading at 30, 40, or even 10 because the premiums of options always price in the volatility properly. The moment market moves 250, 300 points, we are going to feel this is a huge move and we have to do something about it. We can't sit in front of the system straight by not doing anything, even if the market is moving close to around 250, 300 points. So that's the reason we end up adjusting and then the market might again continue or come back and all of the things just happen because the market is volatile. So this is when it comes to the discretionary trading. Now, let us also discuss about the system-based trading. So here I have opened StockMark, which is a backtesting platform. It is one of the India's best backtesting platform, and I have also put out the link in the description below where you can open a free account and get 20 extra credits for backtesting. So here I am going to create a ATM short strategy. So I am going to sell a call option, I am going to sell a put option, and very simply place a, let's say, 70 point stop loss. So this is going to be a very simple point based stop loss of 70 points. All I have done here is sold the ATM call option, sold the ATM put option and placed the stop loss. So let us try executing the strategy at 9:30 in the morning. So now we are going to run the backtesting. So this is not a strategy which I am recommending. This is just to show you how this strategy has behaved under different VIX environment. So here we have the strategy summary. So totally you can see that this strategy is run for 947 plus 510, which is around 1557 days. So out of 1557 days, you can see that 299 days, no stop loss has been triggered, and 219 days, two stop losses are triggered. That means both the stop losses are triggered. So this is for the overall strategy. So one more thing, what is more important is the expectancy. So any strategy with higher expectancy means this strategy is better than the rest. The expectancy of this particular strategy when run on all the days is around 0.23, right? And you can also see the max drawdown, which is almost around 15.96%. So what we are going to do is not actually look at the overall profit because looking at the overall profit is not going to give us the right idea for system trade. So we are going to consider the expectancy, which is 0.23. We are going to see the total number of days no stop loss was hit. So if no stop loss is hit, that means most likely you would be ending that day in a profit. And similarly, if both the stop losses are triggered, then most likely you will be ending the day in a loss because your C stop loss is triggered. Again, the market comes down and your P stop loss gets triggered. And since both the stop losses are triggered, you will be ending the day in a loss. So this is for the entire strategy and let's make a quick note of it. So here we have a simple table where we have the VIX filter. Then we are going to express in terms of percentage the days when no stop loss was triggered the expectancy and the days when two stop losses were triggered. In the overall strategy, we got to know that out of 1557 days, 299 days, no stop loss was triggered. That means when we express this in terms of percentage, 19.2% of the times no stop loss actually got triggered. The expectancy of this strategy is 0.23. Both the stop losses were hit on 219 days out of totally 1557 days, which is almost around 14%. So when we actually look at it, so 19.2% of the days we are for sure making a profit because no stop loss is triggered, and 14% of the days we are for sure making a loss because two stop losses are triggered, and the expectancy of this strategy is 0.23. So one good thing about stock market is it is going to come with a VIX filter. So here we are going to filter the days when VIX was between 1 and 14. So the moment we do that, you can see totally we have 282 plus 143, which is close to around 420 days. And you can also see the expectancy, which has increased to 0.38, right? So here you can see when the VIX was actually under 14, the expectancy from 0.23 suddenly has increased to 0.38. And not just that, when you actually look at the number of days when no stop loss was triggered, that is 177 by 425, which is close to around 42%. So 42% of the days no stop loss was triggered. That means you would be definitely ending in a profit. And only 12 days both the stop losses actually got triggered. So 12 divided by 425 is just around 3%. So now I'll also end up filling this table quickly by putting this. Once I have filled the entire table, you can quite clearly see how the expectancy for a simple system trade drops when the VIX is high, right? So here you can quite clearly see when the VIX is actually under 14, a simple non-directional system trade will have an expectancy of 0.38. Whereas the same strategy when the VIX is over 20 has an expectancy of 0.17. The same strategy is performing more than 2 times better when the VIX is under 14 compared to VIX being over 20. And not just that, when we actually look at the days when no stop losses were triggered. So when VIX is under 14, there are close to around 42% days when no stop loss actually got triggered. But if VIX is above 20, there are close to around just 3% of the days when no stop loss was triggered. And not just that, when we come to where two stop losses were triggered, so when VIX is under 14, there are only 3% of the days when no stop loss was triggered, whereas when the VIX is greater than 20, there is close to around 30% of the days when both the stop losses were triggered. So why is this so important? Because we know that the moment two stop losses are triggered, we are going to end that day in a loss. And similarly, when the moment no stop losses are triggered, that day is going to be a profitable day. That is because when the VIX is low, the volatility is low, and because of which the chances of a stop loss getting hit reduces. And even if the stop loss actually gets hit, so most likely either the trend might continue, which is again going to be beneficial for a system trade, or the market might end up consolidating. The same thing actually reverses when the VIX actually becomes over 20. So here the chances of no stop loss being hit reduces to 3%, whereas the chances of two side stop loss being hit increases to 30%. So in this simple system based strategy, also you can see that this is performing really well when the VIX is actually under 14. So even though the total premium what we get when VIX is below 14 is very less, that is going to be more than enough to be very profitable. So in fact, you're going to be more profitable either by using the system-based trade or also by using the discretionary trade. So in discretionary trade, you'll be profitable for a different reason. And the reason is quite simple. Because the volatility is low, you will be in a better frame of mind to trade and you will not end up adjusting for every 150, 200 point move. Whereas when you're trading system-based, since the range is going to remain small, the chances of no stop loss being hit increases. Because of both of which, it is going to be much better to trade, or it is going to be more profitable to trade when VIX is at a lower level, even though the premiums are lower. I am also going to show you how you can automate this or any other stock market strategy using a free execution platform by Optionables, which is Target. All you have to do is open target.optionables.in and log into your account. In case if you don't have an account, you can also register for free. And once you log in, you can continue with the broker Firstock. And once you get into the platform, you can simply create a new strategy. Let's name the strategy as 930 straddle. So we are going to sell a call option, sell a put option, and we are simply going to place a 70-point stop loss. Once that is done, we are going to put in the entry time, which is 9:30 a.m. and the exit time is 3:20 p.m. So we are going to execute this on all the days from Monday to Friday. Once you have saved, all you have to do is come in the morning and click on run. So you can log in anytime after 8 a.m. Just click on run and Target is going to take care of the complete execution from end to end. So this way you can automate your trades absolutely for free using Target. So if you're interested, do not forget to check this out. With this, we also come to the end of this video and do let us know in the comment section what did you end up learning from this video. Also, do not forget to hit the like button, share this video and subscribe to Optionables.